Imagine being approved for a home loan at 6.5% interest instead of 7.2%, saving you thousands of dollars over the mortgage's lifetime. Or getting a new car with a 4% APR instead of 8%. This isn't luck, it's the power of a strong credit score. For many, this number feels like a mysterious, ever-changing entity, an arbitrary grade that dictates financial opportunities. But it's not arbitrary at all. Your credit score, primarily your Fico score, is a precise calculation based on specific behaviors. Understanding these behaviors is the key to unlocking better rates, lower premiums, and significant financial freedom. We're going to break down the exact percentages that make up your score, starting with the biggest piece of the pie and why it's so critical. The single most impactful factor, making up a whopping 35% of your Fico score, is your payment history. This is simply whether you pay your bills on time. A single late payment, especially if it's 30 days or more overdue, can drop a good credit score by up to 100 points instantly. For example, if your score was 760, a 30-day late payment could push it down to 680 to 710. The older the late payment, the less impact it has, but it stays on your report for 7 years. Creditors see late payments as a major red flag, indicating you might be a risky borrower. This is why setting up automatic payments or calendar reminders is non-negotiable for building and maintaining excellent credit. But what about the amount of debt you carry? That's the second biggest piece, and it's often misunderstood. Next up, accounting for 30% of your score is the amount you owe, often referred to as credit utilization. This isn't just about the total dollar amount of debt, but specifically how much of your available credit you're using. If you have a credit card with a $10,000 limit and you owe $9,000, your utilization is 90%. Lenders prefer to see utilization below 30%, with the best scores often having utilization under 10%. Let's say you have two cards, one with a $5,000 limit and a $1,000 balance, 20% utilization, and another with a $10,000 limit and a $9,000 balance, 90% utilization. Your overall utilization is $10,000 out of $15,000, which is 67%. High utilization signals that you might be over-reliant on credit, even if you pay on time. But there's a common myth about closing old credit cards that directly relates to this. Here's a common mistake. Some people, thinking they're being responsible, close old credit cards once they pay them off. While it feels good, it can actually hurt your credit score. Why? Because closing an old card reduces your total available credit. If you had a $10,000 limit on that card and now it's gone, your overall credit limit decreases. This can suddenly spike your credit utilization ratio on your remaining cards, even if your balances haven't changed. For example, if you had $2,000 in debt across $20,000 in total limits, 10% utilization, closing a $10,000 card means you now have $2,000 in debt across $10,000 in limits, 20% utilization. This jump can negatively impact your score. It's almost always better to keep old, paid-off accounts open, especially if they have no annual fee. But what about how long you've had credit? That's another crucial piece. The length of your credit history accounts for 15% of your Fico score. This factor considers how long your credit accounts have been open, and more specifically, the average age of all your accounts. Lenders like to see a long history of responsible credit use because it gives them more data to assess your reliability. If your oldest account is 15 years old and your newest is 2 years old, your average age will be somewhere in between. This is another reason why closing old, established accounts can be detrimental. It reduces the average age of your accounts. A common scenario: a young adult gets their first credit card at 18, and by 25, they've added a few more. That first card, even if rarely used, contributes significantly to the average age. But establishing new credit also has an impact, and it's not always negative. New credit, representing 10% of your score, considers two main things: the number of recently opened accounts and a number of hard inquiries on your credit report. A hard inquiry happens when a lender checks your credit for a loan or new credit card. Each inquiry can ding your score by a few points, usually 2 to 5, and stays on your report for 2 years, though its impact fades after about a year. Applying for multiple loans or credit cards in a short period can signal to lenders that you might be in financial distress or taking on too much new debt. However, rate shopping for a single loan, like a mortgage or auto loan, within a concentrated period, typically 14 to 45 days, depending on the scoring model, we usually count as just one inquiry. But what about the different types of credit you use? Finally, the credit mix makes up the remaining 10% of your Fico score. This refers to the different types of credit accounts you have, such as revolving credit, like credit cards, and installment credit, like mortgages, auto loans, or student loans. Lenders like to see that you can responsibly manage various types of credit. For instance, having a mix of a credit card and an auto loan demonstrates a broader financial management capability than just having multiple credit cards. It's not about having every type of credit product, but showing diversity. However, you should never take out a loan you don't need just to improve your credit mix. The other factors are far more influential. Now, let's put this all together with a practical example of how a score changes. Let's illustrate with Sarah and her Fico score. Sarah has a 720 score. She has 3 credit cards and a small auto loan. Her payment history is excellent, 100% on time. Her credit utilization is 40% across her cards. Her average account age is 5 years. She recently applied for 1 new credit card, resulting in 1 hard inquiry. Now, imagine Sarah pays down her credit card balances significantly, bringing her overall utilization from 40% down to 15%. This alone, impacting the 30% amounts owed category, could easily boost her score by 30 to 50 points, pushing her into the 750 to 770 range. However, if she suddenly missed a 30-day payment, that 35% payment history factor would dominate, potentially dropping her score by 60 to 100 points, negating all her hard work. Understanding these levers is crucial for proactive management. But what if your score is already low? Here's what happens if you neglect your credit. Meet Mark. Mark, in his early 20s, struggled with managing his first credit card. He often paid late, sometimes 60 or 90 days late, and eventually maxed out the card. His score plummeted into the low 500s. We tried to rent an apartment. He was denied. To buy a used car, he qualified only for a subprime loan with a 22% interest rate, costing him thousands more than if he had a decent score. These mistakes, especially late payments and high utilization, created a cycle of higher costs and limited opportunities. It took Mark years of diligent on-time payments, slowly paying down debt, and avoiding new inquiries to rebuild his score. It's a marathon, not a sprint, but it is absolutely possible to recover. So, how can you start today? To start improving your score today, here are concrete steps. First, get your free credit reports from annualcreditreport.com. Review them for errors. This is critical, as inaccuracies can drag down your score. Second, set up automatic payments for all your credit accounts. Never miss a payment again. Third, focus on reducing your credit card utilization. If you have multiple cards, pay down the one with the highest utilization first, or distribute payments to bring all cards under 30%. A good strategy is to make multiple small payments throughout the month instead of one large payment at the due date. This can keep your reported utilization low, as creditors often report your balance mid-cycle. But what about monitoring your progress? Regularly monitoring your credit score is essential. Many banks and credit card companies now offer free Fico score access through their online portals or mobile apps. Services like Credit Karma or Experian also provide free access to your scores, though sometimes different models than Fico and reports. Check your score monthly to track your progress and quickly identify any unexpected drops, which could signal fraud or an error. Pay close attention to the factors that are most heavily weighted: payment history and credit utilization. Seeing your score gradually climb, even by a few points each month, provides motivation and confirms your strategies are working. It's a clear indication that your financial health is improving, leading to tangible benefits. But there's one more advanced tip for those who are serious about optimizing their score. For an advanced strategy, consider a credit limit increase request. If you've been responsible with a credit card for at least 6 to 12 months, paying on time, and keeping utilization low, Ask your card issuer for an increase. A higher credit limit, assuming you don't increase your spending, will instantly lower your credit utilization ratio. For example, if you have a $1,000 balance on a $5,000 limit, 20% utilization, getting that limit increased to $10,000 means your $1,000 balance is now only 10% utilization. Be aware this might result in a hard inquiry, but the long-term benefit of improved utilization often outweighs this small, temporary dip. Always confirm if the request will be a hard or soft inquiry before proceeding. This can be a powerful move for those looking to push into the excellent score range. Ultimately, your credit score is not a judgment, but a reflection of your financial habits. Focus on consistent, on-time payments and keeping your credit utilization low. These two factors alone account for 65% of your score and are completely within your control. By actively managing these, you're not just improving a number, you're building a foundation for greater financial freedom and opportunity. If you found this breakdown helpful, please subscribe for more practical U.S. personal finance insights.